Good evening, everyone. I'm Nevin Doolabom. I'm president of Church of the Brethren Benefit Trust. Welcome to this session on investing. I've modified the title a little bit from the booklet. I've called it Investing 101 for Congregations Pondering Such a Thing. It also is for individuals. This actually was created initially for a district that was trying to help their congregations think through business aspects of their work. But really the concepts I'll be talking about tonight impact everyone. And so it is a entry-level investment session. We'll be talking about terms and should you have extra funds like reserve funds, either personally or as a congregation, and why, and what kinds of funds and what kind of risk and things like that. So if you are an experienced investor and you would like to go to a more middle type of session for that, our colleague Malcolm Nimick is holding a BBT session right now as well on investing. And Lois, do you have anything to help them find that if they would want to go there? You're muted.
You would go back to the insight session, and the one that Nevin is talking about is viruses and other issues infecting our economy. That session is also being recorded though, and so you would be able to watch it later if you'd like.
So you're welcome to be here. We just want to be clear what this is. This is very entry-level investing. With me is Lois Borgman, who is Assistant Director of Relationships and Growth for BBT, and also Lene Rutherford, who is our Director of Employee Benefits for BBT. And we welcome you all here. One thing I learned about Zoom last night I don't like is I occasionally will have a slide that's a joke, and I can't tell if people are groaning or laughing, but I guess that's the ramifications for trying to be funny when you can't hear or see people. If you go to the chat, I will actually send it one more time for anyone who just came on. If you go to the chat, there are 3 resources there to grab. The first one is the Investments Primer PowerPoint. That is going to be what I share with you tonight. There's also a handout. It's like a study guide to go along with this or to refer back to after the fact. And then there's a lot of definitions that we'll be going through. And rather than make you look at that in the PowerPoint or in the midst of a big handout, I have a handout just for the definitions. So thank you, Michael, for saying that you're smiling and laughing with you. You might be groaning with me before the night's over, but thank you for your optimism. I greatly appreciate that. So with that, let's jump in. I'm going to share my desktop. You should see a slide that says investing for congregations. Do you see that? Okay, thank you. So first joke of the night, just to let you know, there will be 6 designated yawning breaks during this presentation, so please pace your boredom accordingly. The other one that I like is talking about investments. I retire on Friday and I haven't saved a dime. Here's your chance to become a legend. As if that can work. Well, it all shows that we need to do investing, but you can't wait that late in the game to try to have your investment manager be a legend. Actually, what you have to do is plan early and start start early and be consistent with your investing. So let's get into this. The first thing is that whether you are an individual or whether you are representing a church or a district and you're thinking about investing, why have reserve funds? Why have money with which you can invest? So again, this is going to talk a little bit more about congregational life, but I think it's very applicable to individual life as well. And then we're going to go through the language of its own. We at BBT are very good at talking kind of business speak because we work in the business realm all the time, and investing is no different, and you can get lost in there. So I will go through terms in what are official terms, and then my plain text attempts at identifying what they mean. And then we'll look at some investment options if you are looking to invest. and then determine what you should invest in. At least look at the factors that you need to weigh when you're looking to invest. And then if you do go and invest beyond like a bank, services investment managers should offer. If you're an institutional investor, like for a church, an organization that we work with, Brethren Foundation Funds, it's one of our affiliates, we can manage those funds for you. We can't manage your funds if you are a individual. You would have to see a financial planner to ask these questions of, but these are all going to be really good questions if you have not had these before, to raise whether you're representing yourself or an institution. And then we will have a summary. So that's our seminar for tonight. Lois is going to be and Lene are going to be monitoring any questions that you have. You can either speak up or put something in the chat. I can't see you as I'm sharing my desktop, so I'm just going to keep going until somebody tells me to stop. So why have reserve funds? Well, there's a number of reasons. Once you get over the question of should you, and I guess it comes to me that I would think of, is there an immediate need or is there a long-term viability need? An immediate need for a reserve fund, well, sometimes churches get into the question of we shouldn't have reserve funds. We should spend all of our money right away on ministry. And so from a church setting, the question is there a reason to have longer term reserve funds that you have for like a rainy day? And I think you could also say that as an individual. Sometimes it's very difficult for us to save. It might be actually even harder during the pandemic or coming out of the pandemic for people to save. But do you have enough, if you're an individual, to have if the washing machine goes out or something like that? And then there could be a goal to get a little bit more of reserve funds for a rainy day, not knowing what will happen in the future. So reserve funds do several things. Again, this is kind of focused on churches, but I think you can apply it to individuals. Number one, it can provide for a staff. Some folks, if they have investments, they actually draw off of their investments. Not saying that that's a good idea, but they might have enough money that they take, let's say 5% of the invested earnings that they have each year and use it for ministry. It also enables some program the same way. They might use their investment income, or you might use your investment income as a person to help with your expenses. I think that a reserve fund helps to weather the increases and decreases in your either giving if you're an institution, or in your cash flow, the money you have in or the money that you're spending as an individual. At BBT, what we do is we do have reserve funds, and when we are in a good financial position, we add to the reserve funds. And when the markets go down and we have a depletion of the funds for a short period of time, we then will use those reserves so that we can maintain our operations and not have a disruption of service. And so they're kind of an equalizer. And I think that reserves can use that. And also a rainy day fund. You never know when something's going to happen institutionally, where you have a pandemic and you need to tap into some funds, or personally, where during the pandemic, people might have had employment issues where a rainy day fund will be. So you might be asking, okay, but reserve funds could be a checking account, right? Well, they could, but I'm going to show you why you might want to think about different kinds of investments rather than just stick it in your bank. And it's going to come a little bit later in this presentation. But I have a slide that is a real interesting juxtaposition on the different kinds of investments and the earnings that you can have over, let's say, 10 years. You've got to be careful, because if you don't know where you're going, you might not get there. And so if you have a need for reserves, personal or institutional, and you don't make a plan to make it, and you don't have a good plan for how to invest, you probably won't get where you need to be. It's intentional. Just like anything else is intentional. It takes some time. It can almost be like a part-time job at first while you're getting set up. But the rewards of having a good investment system are great. For many people, it can be boring, or it can be confusing, or it can be scary. There's the confusing. Here's the scary. Okay, I'm going to say you're quite adverse to risk, or risk averse. And other people think that it's really confusing. And part of it is because, as I mentioned at the top of the session, there's a language unto its own. So I'm going to try to make the most of it, of this language, and go through some terms. If you have any questions, please ask. So when you're in investing, there's a ton of terms. We're not going to go through all of them, but these are important if you're going to start investing. Number one, there is an asset class. What is an asset class? It's a type of investment that you have. So, for example, keeping your money in the bank could be considered to be an asset class. Having a CD from a bank or financial institution could be an asset class. Owning a stock, which we'll get to later, is an asset class. A bond, having a commodity like gold. All of these are different things that you can invest in. Real estate. Anything that you can invest in is an asset. Some are safer than others. So you need to know what the pros and cons are, so that you can determine what is best for you. Next term is capitalization. Why is this important? So the blue definitions are what I found through business dictionaries. The green is my interpretation. So I'm going to try to stick where I do have green with mine, because I think it's a little bit more plain text. The capitalization of a company is how much it's worth. If they have a stock, let's say they have 10 shares of stock, and the stock is worth $5, you would multiply the $5 times the 10 shares, and the company is worth $50. So when you hear that Apple, the capitalization of Apple is just through the roof, it's because they have a lot of shares and their stock price has gone up. And when you multiply that, they're $1 trillion company. But that's important because there's different characteristics on companies. The large cap, the really big 10 billion plus companies have been around for a long time. They might not be headline grabbers, but they're sustainable and they're predictable and they're pretty reliable. Mid cap, the middle stocks are a little more volatile. You can lose a little bit more, but sometimes you can gain a little bit more because they're smaller companies and they're a little bit more nimble. And small cap stocks, companies that are worth $2 billion or less, actually have volatility. You could lose. I'll get to volatility in a minute, but you also can gain because there's a great opportunity. If a small company grabs market share or has the latest great idea, people can jump in and make that company worth a lot more money really quickly. So you need to know the capitalization of the size of the companies and what kind of asset class you want to be, a small cap, a mid cap, or a large cap, because again, they have different characteristics. And if you're working with a financial planner, they would know that. So the S&P 500 and the Dow, they are benchmarks. They're called indices. They are a standard of measure that can be used to analyze the allocation and return, the risk and return of a given portfolio. But let me tell you what my definition of that is. It's a grouping of investments that are used to judge the performance of similar investments. So for example, BBT, at BBT, our large cap core investment fund is judged against the performance of the S&P 500. The Dow, for example, has 40 large cap, really big companies. And what they do is they look at that every day and they see if the value of those companies have gone up or gone down, and there's an index. And it kind of is a benchmark to let you know whether or not the economy is doing better or worse, the markets are going up or down. The S&P 500 is a little bit better of a indicator of what the business world is doing, because the 500 indicates that there's 500 companies in that. So when you have 500 companies versus 40 companies, the 500 is going to be a better measurer because there's just so much more volume of so many different companies that would not have as much of an error tracking. 40 companies, if they're all kind of the same, can make it seem like the economy is going crazy. 500 is going to have different sectors in the 500 companies, and so they are much more of a true reflection of the business world in the United States. Okay, bonds. So what's a bond? It's called a fixed instrument. It's a fixed income instrument. And it represents a loan made by an investor. So a stock, you actually buy part of the company. And as the company gets successful or not successful, your ownership of the stock could go up or could go down. And when you sell it, you get that back. A bond is a loan. You're not buying a part of the company, but you might be buying into like a 30-year loan, almost like a mortgage, a 30-year loan by a company that's going to pay you back at an interest rate. Usually these are much more stable. They don't fluctuate near as crazily as stocks do. But the problem with bonds right now is that they really are predicated on what the going interest rates are. And if you have followed interest rates since 2009 have been extremely low. And therefore bond prices have been historically low over the last decade. And so they have not been, when the interest rates were at 5, 6, 7% and bond yields were up that high, you could get a really good return on your investment and it was relatively safe. Right now, the bond yields are much lower than that. And so if you want to make money as an investor, you really have had to, over the last decade, take more risk with stocks. So there's two kinds of bonds, two basic kinds. Corporations can do that. I know BBT, we have 2 bond managers and we have holdings of a lot of the mainline companies that you would expect. Many issue bonds to raise money so that they can reinvest it in their operations. But the US government also has bonds. They're called US Treasuries. So when you hear that the Fed is flooding the market with treasuries, they're selling bonds. They're trying to raise cash by selling the bonds. And those are thought to be the most reliable investment around, other than just keeping cash, because no one thinks the US government is going to fold. Whereas a company could go out of business, the treasuries are going to be good as long as the US government's here. And so they are thought to be one of the safest investment asset classes that you can go into. My terminology is a loan from an investor to a corporation or governmental organization for agreed to interest rate and time horizon. It is called a fixed income instrument because the income generated over the life of the loan is established with a set interest rate. So there's not a lot of surprises. And I'm sorry, I think I said that my definition was in blue, but it's in green. So the Dow Jones Industrial, it's at 40. The New York Stock Exchange, well, here I thought it was 40. Here I have it's 30 large cap companies that are the leaders. I've already explained this one, but that's one of the indexes, the Dow Jones. You hear that the most, and you hear a lot about the S&P. So what is an equity or a stock? That's where you buy part of a company. A publicly traded company issues equities or stocks to raise funds, which is called capital. Ownership of the firm is held by the shareholders. If you've joined us late, all of these definitions are in the chat. And there's 3 documents, a PowerPoint, an outline, and the definitions. This investment does not provide a fixed rate of return. The company performance and market forces dictate. So if the markets go up, the worth of that company will go up and your holding will go up. If the companies lose money, your holding will go down. One of the hard things about stocks right now for people who have owned them is that for the last 10 years, basically, the market has been marching slowly up. It's had very little down, to the point that people are just expect it to go up and aren't prepared for the up and down of the stock market. But rest assured, there will be down times and there are up times. And we've been really fortunate over the last The only time where it really dipped was last March, a year ago, March, and that recovered within like 2 months because of the beginning of the pandemic. The Federal Reserve, known as the Fed, was established in 1913. It serves as the central bank of the United States. And it has a mandate to keep our money valuable and our financial system healthy. So it engages with its monetary policy, and it sets loan rates that lenders then take off of. It sets some discount rates and federal fund loans rates, and from that comes savings rates. The banks look at what the Fed is doing, and then they use that to help them set their rates. They also do some loaning of money in between the different Federal Reserve branches. And my definition is it's a country's central bank that sets basic interest rates from which other interest rates, such as for cars, homes, bonds, are established. You might hear about high yield or junk bonds. What does that mean? If you are buying a bond, which again is a loan from a company, do you want to buy a junk one? Well, it's a matter of how much risk you have, you want to take. Junk bonds are from companies that are rated riskier and lower quality. They have a much more possibility of perhaps defaulting on their loan. But because of that, they also then outproduce. Their rates are usually higher when they're doing well, and they can lose, unlike the regular bonds. So if you are willing to take some risk and you want higher bond yields, you go for the companies that they have to pay higher rates because their status as being subpar companies. Nobody would invest money if they weren't getting a premium for that risk that they're taking. So you get a premium as long as the company stays solvent, but there's a bit of risk, and that's why they're called high yield or junk bonds. An index is, I'm going to just go down to the green, a subset grouping of a specific type of market investment that is calculated from the average price of the grouping. So the S&P 500 companies from the country, they put that together and they have the index. The index tells you on an average how these 500 companies did for the day, whether they went up or they went down. And from that, you can get a sense on how the markets are doing. So there's a lot of indexes. There's an index from overseas, the Far East and Asia. There's a ton of them. There's Russell 2000 for smaller cap stocks. But the most popular ones that you will hear on the news are the Dow and the S&P 500. Inflation, this is something that's important to know, whether you're an investor or you're not, because we've been very lucky over the last years that inflation, or the costs of goods going up, it's a measurement of how much more or less goods cost over a certain amount of time. This increase or decrease of inflation can increase or decrease a person's buying power as goods and services increase or decrease in their costs. Over the last number of years, inflation has been very low, 1 to 2%. But recently, because of the pandemic and the supply chain shortages, lumber has gone up. I've read that a new home, the lumber increase, the cost of lumber, the jump in lumber costs for a new home has gone up $36,000 during the pandemic. That's inflation. We've seen gasoline over the last couple of months go up from in the $2 range into the $3 range, at least here in Illinois. That's inflation. Food prices are going up. What it seems to happen is that the supply chains, because there wasn't as much demand, they slowed their production down. And now that people are coming out of the pandemic, there's a great demand for goods, and the supply chain has got to start keeping up. The supply chain is all of the processes that need to get a good to you. And, the airlines had furloughed planes, restaurant workers were furloughed, and now restaurants can't find enough workers. So there's a huge supply chain issue going on. And what's the result? their costs have gone up because it costs more when there's not as good a supply. And so inflation has gone up. I think I read it's gone up 5% in the last few months. We'll see if it tapers off as the supply chain checks up. But the reason why that's important, let's say inflation goes up at 5% and you're in a CD, you invest something in a CD at your bank and you're getting 0.5%. Well, your CD is going to go up 0.5%, but over the course of, let's say, the next year, goods are going to cost 5% more. So your buying power actually has gone down 4.5%. You've actually lost buying power, even though you thought you might be safe with having that in. You need to try to have investments that outproduce whatever the inflation is so that your buying power stays the same or improves. That's why inflation is really important. There's another term that we talk about in investing. It's called index funds. And BBT has index funds in our pension plan. An index fund is a mutual fund that's designed to invest in the firms that are included in an investment index. So, for example, you might have an S&P 500 index. The manager doesn't decide what to put in that investment for you. They invest in the 500 companies that are in the S&P. Or if there's a Dow index, you would invest in the companies that are in the Dow. So the idea is if, as you're watching an index, if you buy an index fund that's tracking that index, your investment should go up and down as that index does. It won't outperform it. It won't underperform it. It should track it because it's investing in theoretically the same thing that is in that index. And that's usually those are much lower cost because you don't have a manager trying to figure out which company to invest in. They just follow the index. And so those fees are much lower. And it's a staple of many investment platforms, including the Brethren Pension Plan. So liquid assets, this is something that's really important to think about, whether you are an individual or whether you are an institution. A liquid asset is something that you can get quickly. So you don't want to, like a real estate would not be liquid. You would have to, if you invested in real estate, you'd have to sell it before you could get your money out of it. And that can take some time. And if your property has gone down in value, you could lose money. So oftentimes you need to have some money, like for that rainy day fund, that you can convert. So a CD, for example, usually locks in for a year or 2 or 3 or 5. That's not real liquid. The Brethren Pension Plan money, you cannot get the money out until you retire. So this would not be a great savings. It's not a savings, it's a retirement plan. If you are an institution and you use Brethren Foundation funds, which we run, we can have money to the churches or districts or organizations within about 2 or 3 days, regardless of what you're invested in. So that's one reason why it's good to go with a company if you're an institutional investor, because we have enough economies that we can get liquidity for you and get your money for you, even if you are invested in something longer term. Anyway, liquid assets, you need to make sure that you have some cash would be liquid. A savings account would be liquid. The Brethren Foundation funds money would be liquid. And you need to have some of that. You also can have longer money tied up in investments because you're not going to need it for some time. So you need to decide how much money you need, and that should stay liquid. You need to find out how much money you might have if you might need in case there's a short-term emergency, like the $500 to pay for new brakes of a car or a new washing machine or something like that. And that should be all liquid. A mutual fund, remember how I talked about how you would buy a stock and then you actually own part of the company? But then I also talked about an index fund where people put together like the 500 companies of an index like the S&P, and you actually purchase that. That's a mutual fund. So someone else is actually buying all the stocks and they have the ownership, and you're buying a portion of that, and it's called a mutual fund. It allows somebody else to do the management of the stocks. It allows someone else to take all that responsibility and you just buy into that fund. So those are very prevalent. At BBT, we have managers that manage funds and they pick the stocks themselves, but we also have some index funds and some what we call diversifiers, some funds with just a little bit of money in. And so we actually buy mutual funds for those funds. So that's what a mutual fund is. A public versus private company. It's important to know, but a public company is what you can invest in. And you can invest sometimes in private companies, but it's a lot harder. And certainly I don't think novice investors would want to do that. You tend to lock your money away for a long period of time. There's less reporting that's needed by a private company if they take investments at all. So normally you try to stay on the public side. At least that's what I would recognize or recommend. Now here's one, when you're investing, this is really important concept too. A realized versus an unrealized gain. Let's say I buy that stock, let's say I buy 10 shares at $5 each in the company. So I have 10 shares, $5 each, $50. The market goes down. All of a sudden my value is worth $25. If I don't do anything, it doesn't matter because I haven't sold my stock. So in another week, that stock price might go back up again. And when I sell it then, I haven't lost anything. One of the hardest things about being a long-term investor, especially like the pension plan, is to be invested in money and watch the markets go up and down, because all of a sudden your retirement account balance can go down for a little bit. But if you have a number of years before you're going to retire, you really shouldn't worry about that. And you really shouldn't make a change. The worst thing that people can do is be invested, watch the market go down, and then they panic and they say, I don't want to lose anymore, and I'm going to sell. What you do is you now have sold at a loss, and it's not going to be easy to get that back. Whereas if you're investing for a long term, you can watch it go down. Like in 2009, when the market collapsed, or a year ago, March, the markets went way down. And if people didn't panic, the markets came back up again. Now, if you need your money during that time, then you have to sell low, but you don't try to panic if you have years ahead of you. And that's one of the components I'm going to get to of what is your time horizon? How long can you invest for? A self-managed fund is somebody who you hire to pick stocks for you. We have that at BBT. We have some self-managed funds. And then a shareholder is a person who purchases a stock. A shareholder owns part of a company. I have S&P 500. I've already talked about that. I'm going to move on. The treasuries are bonds from the US government. And it's considered to be, it's fixed because the interest rate is set and doesn't change. It's safe as it's backed by the US government. And then time horizon. I'm going to go to the second one. Oh, I'm sorry, I don't have a second one. The time horizon is the length of time over which an investment is made before it is liquidated. So once again, are you going to make an investment? If it's an institutional one, you might have an NYC fund, and you don't need that for 4 years, but you don't want to lose a lot of money. So that would tell you what your time horizon is, and that would also tell you how much risk you want to take, because if your youth are raising money, you don't want to lose money by investing it and having the markets go down. So you would pick a really safe investment asset class. But let's say you're in a retirement plan and you're going to be in for 30 years. You can take a bit more risk because the markets are going to go up and they're going to go down. But generally speaking, over time, the market goes up. And so again, you need to talk to a financial planner about this. But the time horizon is, and there's, if you could open up the hood, you could see this. So let me very quickly describe this. If you were to look, even if you're not in our pension plan, if you went on our website, which is brethren.org, and you look at pension and you look at what's called the pension perspective, on the back page of the pension perspective are what's called target date funds. And there's I think a 2065 or 55, 2045, 2035, 2025, and 2015. those are all geared for when you're going to retire. The time horizon is different in 10-year increments. So the one that is past the retirement date or coming up to it, you don't have a lot of time horizon. So it's going to be invested in a way that's going to try to keep you from losing money if the market goes down. But if you go out to the far one, like the 2055, it says, hey, look, the markets are going to go up over time. You don't need this money for 30 plus years. So we're going to invest in more risk, but more reward so that we can grow your account so that you have a great retirement balance when you retire. So the time horizon, regardless of what you're investing in, is really important. And then volatility is, a volatile investment greatly fluctuates in price, making it less predictable and stable. So there's grades of this. An equity is more volatile than a bond, right? A high yield bond or a junk bond is more volatile than a regular bond. Cash is not volatile at all, but you get stuck with inflation because it doesn't grow. It doesn't earn anything, so it might not seem to be volatile, but it's actually going to lose money consistently if there's inflation. So you need to think about, what is the volatility that you're looking for? What risk are you willing to have? So this is what I call a language of its own. Again, all these definitions are on the sheet, and I'm glad to answer any questions, particularly when we get done here. Let's keep moving. So there's lots of different investment options, whether you are an individual or you are an institution. So for example, if you go to a bank, you could have a savings account, a checking account, or CD accounts. If you look at the rates, I looked at the rates for savings just the other day, and what I could find online for the best savings rate I could find was at a 0.5 percentage point. So the checking and the CDs might be a little higher the longer you go out, but they're not real robust savings mechanisms. Certainly not going to keep up with inflation. You could buy a portion of a company. You could buy the stocks that we talked about. You could buy commodities, stuff like gold, silver, oil, pork bellies, piece of property. You could give a long-term loan to a company. That's a bond. It's more stable, longer term, doesn't fluctuate. And if the company is in good standing, you're going to get your money back. But rates are low right now, so it's not as high. You're not going to get as much as you would have 10 years ago. You can invest in stocks through a mutual fund. So you don't have to take the risk of buying the companies yourself. Let someone else do that and buy the mutual fund. And you can use your investment manager to learn of your needs and then manage your funds accordingly. That's really what you should do. But when they talk in these terms, you hopefully will understand what it is that they're saying. So this is what I call determining what you should invest in. I don't have any answers. I'm a nonprofit. Okay, I had to throw that one in. So determining what to invest in. What are the goals with the investments? What is the time horizon? What are other factors to consider? And what's the risk versus reward? We're going to go through these real quickly. So what are the goals that you have with the investment, whether it be your own personal or an institution's money that you manage? Is it to preserve? Is it to grow? Are you looking for the lowest fees? Are you looking for the highest gains? And do you want to invest in values? We at BBT have learned that we can screen out investments that don't comport with Brethren annual conference statements. And we usually either meet the benchmarks or exceed the benchmarks, which means you're not paying a price to invest in your values. And I like to call that having your cake and eating it too. But what's important to you? Is values-based investing important? Lowest fees? You trying to grow? Or are you trying to preserve? You need to think through those. Inform everyone that there will be no tweaking of this investment strategy until further notice. Well, we don't believe that the market's always going to go up, but there is something that is to be said that actually is some truth to this. And that is, you should look at your time horizon, you should look at your risk tolerance, you should look at a number of factors, and you should set your investment strategy and you should let it go because the markets will fluctuate. But you should let it go because you don't want to buy something at a high price and sell at a low price. You'll lose money that way. So here's another factor to consider: the time horizon. As we talked about, when will you need the funds? What are some other factors? How about diversification? Now, what that means is in the S&P 500, those companies that are in that S&P 500 would represent manufacturing, perhaps energy, transportation, entertainment. There would be like 8 or 9 sectors that are represented. So healthcare, if consumer staples. So if one, let's say there's a drought and groceries go crazy, and all the companies that work with groceries take a hit and they suddenly go down. Well, if you are diversified, you have a small bit of your investments in that category, but you also have other categories that you believe will weather the storm if another category goes down. And that's how you try to hedge your bets so that you don't lose money even when some of the sectors are going down. Now, a mutual fund would be diversified. In fact, if you happen to be in the Brother Pension Plan, even our self-managed funds are diversified as well. We have strong guidelines with which to make sure we have diversification. But if you're doing this on your own, individually or for an institution, and you don't have investment guidelines, you need to think very seriously about not putting all your money in one area. In 2001, many people thought the dot-com bubble was going gangbusters, and they were investing in technology companies like crazy. And then that bubble burst, and people who had spent a lot of their money on one sector, they were not diversified, they lost a lot of money. So you need to diversify, and an investment manager can help you with that. Liquidity is how fast can I get my money? There are, again, you need to figure out how much you want to be able to call in if you have a need, and you can invest the rest. So for example, here's an example of this. Our retirement fund that pays the annuities of the Brother Pension Plan, we pay out about 1,700, a little over 1,700 annuities a month. And what we have done is we have set aside enough money to pay 3 years worth of annuities in low risk investments. And the rest of it is in a little bit higher risk, because we know that the markets within 2 years of going down, statistically and historically, they come back. We're not going to realize that gain, right? Because we're not going to pull money out of this. And so we're going to take a little more risk here, knowing that we have 3 years of payments here. And that's a pretty good strategy that's worked well for us. And that might be something that you want to think about, this kind of 2-bucket approach, to have some short-term money that's safe and liquid, but then have some longer term if you have a longer term time horizon. What about the risk versus reward? Now, this is a graph that came from Brethren Foundation Funds, which manages money for about 200 Church of the Brethren organizations, but it still applies whether you're an individual investor or an institutional one. There's a funds chart, there's a risk reward chart, and then I want to show you a returns comparison. So what we give to our investment or institutional investors is we say, look at this graph. If you want to look at what's expected risk, this is low expected risk, this is high, and this is low expected return, and this is high. So the higher up you go, the more expected risk you're going to have, but you're also going to have expected return. And so what we do is we show you the different asset classes that we have, and you have to decide then where would you want to be on that spectrum of that risk and reward. Another chart that we use for our institutional clients is this one. So if you look at what is your time horizon, and then what is your risk tolerance, you can work out a very simple asset allocation by looking at the grid. If you're in the Brethren Pension Plan, we have tools online. If you are a foundation client, I'd have you talk to Steve Mason. And if you're an individual investor not utilizing BBT in any way, a financial planner can help you. Now, why invest rather than in a bank? Now, these numbers are not quite honest because I will tell you. But for example, this is right now, I could find an interest rate at a bank, a savings rate of 0.5 percentage point. So if I believe that that's going to stay the same way for 10 years, that's going to yield 5% over 10 years. Inflation is probably going to be more like 30%. So you're going to lose your buying power. This represents right now the 10-year, the average 10-year bond is yielding 1.7%. So if that held over 10 years, you had that bond, you would earn back 17%. The S&P 500 over the last 10 years earned 92%. There's more risk. There's a lot more reward. Totally outpaces inflation. But again, the markets can go down. So you might want to put some money in one of these lower risks for liquidity and for short-term needs. And then if you don't need money for a while, put it in a longer-term risk to try to grow that. So that's a strategy. But I think this chart is telling why it's important to really be thoughtful about what you do with your money, whether you're at a church or whether you are an individual trying to manage your funds. So some services that if you are an institutional client, like a church, we serve many churches. And actually, if you're an individual, you should have much of these same tools from any place that you go to manage and to buy an asset class. You should have online account access. You should be able to look at your account balance as of the end of the last business day. By midnight tonight, anyone who's in our pension plan or has their assets institutionally, they can look and see what their account balance is at the end of today. There should be information about the funds and the program so that you can learn what you're invested in, what's the risk and what are the fees. There should be fee disclosure. And then there should be a support, and they should be offering you competitive investments. And if it's important to you, you should look for companies that offer value-based funds. So again, we believe that you can invest in your values and be just as successful as non-values-based funds, but it feels good to invest in something that has meaning. Here, if you're an institutional client of ours, this is the online access portal that we have. I actually am the board chair of my local congregation, and so I have access to those funds through our BBT portal. It gives you online account access, custom reports. That's another thing. You can do custom reports. So if you want to know, let's say how much you've earned on your portfolio since tax day, since April 17th or April 15th, on the typical tax day, you can put any numbers in and find out what your account has done with whatever parameters you want. Transactions, newsletters, an information statement talking about the fund. Other services you should receive information about the funds and the program. We have on the foundation side, we have what's called an information statement. It tells you all the funds, all the fees, everything, and then forms that you can use if you're a congregation or institution. And disclosure of fees as well. I'm sorry, I was not trying to gloss over that. You should have support, especially institutionally, visits, on-site visits, toll-free phone calls, and resources. And the investment should be very competitive. Any good manager of funds, including we benchmark, we look how we're doing in the industry and try to stay as competitive as we can. And then there's reporting. So for example, this is the institutional newsletter that we have. Lene in the pension plan, her team does pension perspective, and you would see pension numbers on the back of that. These are the institutional client numbers, but wherever you invest in, you should receive reports like this. And then, of course, if there's any values-based fund that you're looking for, you should reach out after those. What we do at BBT is we screen out companies that don't conform to annual conference statements. We actually will purchase some companies and try to get them to be better citizens. And then we also have a fund that's a community development fund that invests money into redevelopment areas that can't get investment from elsewhere. So we call that our ministry fund. And I've already told you that I think our BVI returns generally equal or outperform non-screen. So in summary, having reserve funds, I think if possible, is good. You should decide what the goals and the needs are for the funds. You should figure out the investment choices to meet your needs. You should make sure that the price is competitive. If you believe in investing with values, we call our value screening brother in value investments, but you should make sure that your investments are in keeping with your values, and that you should have helpful, proactive customer service and online access to help meet your needs. Harold's more interested in the vault capacity. Here, they're looking to put their money into a mattress. I hope that this program tonight has shown you that with a little bit of knowledge and some good advice from an investment manager or institutionally someone like Brethren Foundation Funds, your questions can be answered, your money can be invested safely, and you can have your financial goals met long-term with the proper planning. So that's the presentation tonight. I am glad to answer any questions that you might have. Or staff, Lois or Lene, if there's anything that you think I've missed that I should add, or if you would like to add anything, please jump in.
So what's next?
You mean what would be your next step?
Yeah, what's the next thing we should do, being students of 101 level?
Well, I think what you should do is get some experience. I think you should, regardless of whether it's someone like BBT or a financial planner, I think you should go and start talking, because all of these concepts, if these are relatively new, are going to be lost if you don't apply them. And once you start applying them, it's just like anything, as you get experience, you become better at it and more knowledgeable, and maybe a little bit more willing to take, I don't know, a little bit more risk, or being a little bit smarter. So I think it's important to have reserve funds and to have investments, and you just need to get started. So what you would do is, if you want to start out small, allocate a small amount of funds and find the appropriate person to help you and get started that way.
How do you find a good financial advisor?
Lene worked at a bank for a long time. She might have a different take than I do. I tend to query people who I know, whether it be at church or at work. I believe in relationships. I want somebody who has served people well, who have a good track record. I'm sure there are other ways at identifying that. Lene, you probably can do a far better job at answering this than me.
I don't know that I can. I would say similar. The only other part I was going to add is, if any of the folks in this session here are part of our Brethren Pension Plan, to let you know that we have tools available to help you model, based on your risk tolerance and your time horizon, what good investments for you would be. And we also partner with Edelman Financial Engines, the top the fiduciary advisory organization or company in the country, rated #1 by Barron's multiple years in a row. And they provide the fiduciary level advice for our pension plan members who have who inquire of their services. So we have tools on the pension side to assist with that, and they also can handle full financial advising as well as one of the services that they provide. But aside from that, I would agree with Nevin that consulting and getting recommendations from people is a good way to do it. Because if you talk to the other thing is to look at, I guess, Is it someone who is purely paid commission by an investment house, or is it somebody that has well-rounded experiences and backgrounds, or can give you more objective or a greater breadth of options for your investing?
Yeah, so one of the things that you might do is query somebody who actually has the education to be knowledgeable. I for a time was using our financial planner stopped being a planner. They went out of business, not because they chose to get out of the business. And so we had to go someplace else. And we went to a very famous brokerage firm that we were referred to. And as it turns out, I think I know as much as the person working there because they've had a basic education, but they kind of use the grids that I showed you. And they really don't know the underlying background. But for example, on our BBT board, we have a man named Jerry Patterson, who, it's kind of funny, he actually was a rocket scientist. So he can say, this is not rocket science because he knows what rocket science is, but he's been a financial planner for many, many years now. But he really knows his stuff, and he's our investment chair. He's a financial planner who is not just going by what modeling would suggest that a company gives, but he really understands his stuff. So I would probably interview somebody before you said okay, and try to see if they are just using someone else's pre-programmed system and just regurgitating what they're learning, or whether they actually understand it. And because they're going to be much more proactive for you if they really understand the markets and understand your needs and not just put you in a cookie cutter mold. So I'm glad you asked that, because I hadn't really thought about that answer, but I did not have nearly as much satisfaction with the cookie cutter approach than someone who really knows what they're doing. What other questions would you have?
Realize this isn't directly an investment question, but do you have any guidance on gifting or as a nonprofit receiving appreciated assets?
In terms of like a policy or what?
Yeah, or guidelines along those lines, because as I understand that, you can, I could gift a nonprofit an appreciated asset, and then I'm not paying gains on that. Is that correct? But I can write off the full amount of that donation.
I don't know if Lene wants to jump in. Our person who's a specialist of that is not on this call. He's on our other investment session tonight. His name is Steve Mason. Lois will put in his contact information, and you can look in the chat for that in just a second once he gets that. But I would rather you reach out to Steve and make sure you get the accurate one than me trying to guess. I know that personally I've worked with, on the other end, with our local church of having a gift acceptance policy, what we will receive and what we won't receive, with the Brethren Foundation managing those gifts. But in terms of the strategy for an individual on what mechanism to use to try to be tax advantageous, Steve would help you out.
Yeah, and I guess kind of part two you hit on a little bit was as a nonprofit receiving appreciated assets. You know, what typically do you do with those? Do you typically hang on to those? Do you have a policy that says you sell it or what's the basis for the donation? Would Steve be the appropriate person for all those questions as well?
Well, I think so. I mean, I don't know that there is, I don't think that we have a template for a good gift policy. I would be glad to show you my churches. They talked to Steve as they were creating it. But really, once a gift comes in, the expectation is that it's liquidated right away, or as soon as practicable. There's no one that wants to hold on to either property. The other thing is that as an institution receiving gifts, you have to make sure that it makes sense. You don't want someone to donate 600 pounds of bird feed to a church. So what are you going to do with it? And so I actually heard that happen. So you want to make sure that you have a policy that could say, well, thank you so much, but we really can't accept this. Because if it's not practicable, if you can't liquidate it into money, it's not really helpful. Lene or Lois?
And Nevin, Brethren Foundation can help you. Like if your church would get a stock gift, we can help sell it. In fact, Nevin, one time we got a walnut grove, right? And
We
we
did.
helped sell them.
Interesting. Yeah, I was thinking in terms simply of stock, but yeah, that's interesting. The idea of being gifted something like a walnut grove.
In
Interesting.
fact, if you watch the memorial tribute tomorrow, there's a woman named Berkeley Davis who passed away this past year, and she and her husband were the ones who did that. They had a property in California, and they gifted that, and Brethren Foundation took it, and the gift went to a couple Church of the Brethren organizations. That's the other thing that we can do, is that if someone wants to give a gift to multiple agencies, we can manage that for all those agencies as well. But Steve would be a good person, and if you look at the chat, Lois has put Steve's contact information on. Thank you, Lois.
Thank you.
Well, we are at time. We're glad to stay on if you have questions. If you are done with your evening, thank you for joining us, and I hope that this was an experience that was worth your while. But if you have questions, we'll stay on until all the questions are answered.
And one more thing as a reminder, if you're a pastor and looking to get CEUs, this insight session will give you 0.1 CEUs.
And how do they know how to do that? You want to just reiterate how to do that?
I hope so. I'm not sure you can point how to do it. I think they just have to report it. I think there's a sheet in the back of their delegate packet or whatever, and I think they just submit it themselves. Is that right, Jeff? You're shaking your head, yes. Thank you.
Doug, you're muted. You're muted.
I do that all the time. Yeah, the back of the conference book, last 2 pages of the conference book, and they've said just place a check beside it, and then